what we're seeing on colocation, on HPC, on edge data centers. There's a little bit more complexity in the business models, but that lends itself to what we like to do, which is take the time to really understand them. It's a lot more due diligence, it's a more involved due diligence exercise, but ultimately that's why the returns are there as well.
Hello and welcome to Cool Vector. I'm David Snow, your host, and today we're joined by Sacha Kamp and Paul Colatrella, both of Infranity. Sacha and Paul, welcome to Cool Vector today. Thanks for being here. Great to be talking to both of you. Sacha, where are you sitting right now?
I am in our offices, our headquarters in Paris.
Excellent. So you're in Paris, and Paul, the reason you're in New York is because Infranity has expanded its lending to infrastructure business to the US, to North America. And you are in charge of that business, Paul, and so we're going to learn about that. But first of all, why don't we learn about just sort of Infranity in general? It's headquartered in Paris. What led the leadership of Infranity to decide that its style of sustainable lending to infrastructure was a good fit for the U.S. market?
U.S. is probably the most dynamic market in the world. From a diversification perspective, it's sensible. You need to be in that market. From a broader Infranity perspective, we have ambitions to be more present and investing consistently in that market.
The managers have done a great job in building out the Infranity brand and footprint in Europe. The firm certainly has ambitions to be a global player in the infra debt market overall. Obviously, Infranity's roots come from Europe, but the United States market is slightly bigger than the European market. So it's really just a place you need to be.
I'd love to dig a little bit deeper into the history of Infranity and its commitment to ESG, to sustainability. Infranity is a joint venture partner with Generali from Italy. Maybe, Sacha, can you talk about the origins of Infranity and how it is that sustainable investing, sustainable lending became sort of a core principle of the business?
Yeah, it's something that we've been integrating into the business since day one, really, right? So the platform started almost 7 years ago now, and it's really been part of the strategy to integrate sustainable investing into what we do, and to recognize the tremendous potential that the infrastructure asset class has to contribute to sustainability, to delivering essential services of benefit to the economy, to society, and also potentially to the environment. Generali and indeed other LPs, particularly in Europe, but increasingly in Asia and also in North America, are focused on how their capital is being invested, what sort of repercussions that's having, what benefits that's having, how it's creating positive change. It's been a good confluence of both, our own convictions as a firm and the demand that we're seeing within the LP market.
Yeah, let's pause briefly on the LP market. Would you say that your orientation towards sustainable investing is a competitive advantage with institutional investors, particularly in Europe, given that they now have much more of an orientation towards all things sustainable?
They are also under a lot of pressure from a regulatory perspective, from their own investor base, to be delivering results from a sustainability perspective. And so we like to be able to offer them a solution whereby they can deploy their capital in a manner that optimizes their own risk return within this asset class, which is a very good, uncorrelated, diversifying asset class, while at the same time meeting the demands that are being put on them increasingly from a sustainability perspective.
Have you had many conversations with US-based institutions about the Infranity strategy, and are you finding enthusiasm for the fact that obviously you need to be good at lending, but also that you have this sustainable orientation?
I've had meetings with scores of US and Canadian investors over the past several years. And so I think there's definitely a large segment of the LP market for whom sustainability and environmental concerns specifically totally resonate and are strong and are either a priority or certainly a welcome addition to the overall investing strategy. As we all know, from some things in the news, there are smaller segments of the LP market, specifically in the United States, that are either neutral to sustainability or they don't want sustainability being at the forefront. They want risk and return at the forefront, and sustainability less focused. But absolutely, I think maybe Europe is ahead and more concentrated in terms of how LPs think about sustainability. But there's a material segment in the US and also in Canada that who understand those issues and for whom that is a priority in their choosing managers.
Sustainability is also very much about risk. The regulatory risk, the market risk that a business might be exposed to. In infrastructure investing, we're we're long-term investors. Transactions can range anywhere from sort of 5 to 25 years. We think that there's significant risk to players that are not paying, due attention to sustainability topics.
Paul, so Infranity is now open for business in North America. If you could summarize, what is your opportunity flow looking like, particularly within digital infrastructure?
We've had already over 40 potential screenings of deal opportunities, a lot as you would expect in energy transition and a lot in digitalization, which are kind of the two core pillars for Infranity. And most of those opportunities fit into one or the other of those segments. So specifically in the digital space, the deal count we've seen is in data centers. And for us, co-location data centers seems to be sort of the sweet spot in the US right now. So we're working on some of those opportunities. We do see fiber, both fiber to premises, fiber to home, fiber to business, which could be interesting as well. And then we see some small cell opportunities, things where 5G doesn't penetrate well and where you want to have a different technology inside, say, a stadium or an airport or a series of buildings like that. And then, general energy transition, renewable energy is probably the second biggest tier of opportunities we're seeing. And then other things around circular economy, waste to value, water and infrastructure around water and transportation could also be, something that we'll visit.
What size are we talking about as far as data center opportunities that are within Infranity's sweet spot?
We typically look to invest approximately 100 million to 200 million or slightly more in each investment. So what that means for us is either being the sole lender on something that falls within that size, or being a leader in a small club of lenders where maybe the opportunity set would go up to, say, 500 million. And a lot of those data centers, all but the very, very largest hyperscale, fall, I think well within that bandwidth.
Can you characterize where you see private debt in particular playing a role versus perhaps much larger lenders for larger, my guess is hyperscaler type of deals?
The hyperscalers are accessing either a combination of bank or ABS financing, which is, definitely lower cost, and might have, might serve their needs, has a larger market that serves their needs a little bit better. But yeah, I see us playing as well in tier 2 and maybe tier 3 markets with tenants, but with tenants that are still household names, but, on co-location data centers where these are companies whose main business is not technology related. They're in retail, they're in food distribution, they're in manufacturing, things where the IT component is not kind of core to the business and where they want to outsource that basically. The tenants themselves tend to have very good credit ratings. The leases may not be quite as long, but there's very low limits to the churn, and you have a really diverse pool of potential tenants to the data center where you can get comfortable and have a really strong credit. That's a lot of what we're seeing. And I think that's where private debt, whether it's funds or finance companies, things like that, will have a role.
How would you characterize the risk and the size of a co-location type of business versus some of these hyperscaler mega campuses that are being built?
The hyperscaler is basically a dedicated data center where you have kind of a permanent tenant in, these names that we've thrown around, the Microsofts, Googles, things like that, all of which right now are very, very, very strong investment grade credits. So, there's a certain kind of very traditional project finance look to that, where you used to build a power plant and that power plant would sell all the energy to the local utility, which was investment grade. It kind of feels like that. And I think that gives lenders a lot of comfort. The co-location is more really the wholesale or retail end of that market, where you've got, could be, if it's a portfolio, could be, hundreds of customers that are, as I said, smaller scale in general, but also generally blue chip names, Fortune 500 types of names. Those contracts tend to be a little bit shorter. They can be, anywhere from a couple of years to maybe, 5 years or so. And you will see some churn, but there's enough demand and enough diversity in the portfolio that you can get comfort there. And that credit analysis lends itself a little bit more to funds looking for an enhanced return. We just are getting more and more comfortable with the co-location model, choosing what we think are the good players there. Geography is a big focus as well, and then also just the model that they use, and if they have some advantages with cost of power or again location. As I mentioned, you want to be close to those customers. They still like that, not for latency, but just for that physical connectiveness to where their data is sitting. So if you're within an hour's drive of a tier 2 market, mid-sized city in the US, that can be very valuable and can give you comfort that there's going to be a core market to sell that data product.
What we're seeing on colocation, on HPC, on edge data centers, there's a little bit more complexity in the business models, but that lends itself to what we like to do, which is take the time to really understand them. It's a lot more due diligence, more involved due diligence exercise, but ultimately that's why the returns are there as well.
How would you characterize the percentage of the deal flow between the three main pillars of digital infrastructure: data centers, towers, and fiber. What's in your deal flow, and how does it all break down?
Sure, it may be different in Europe, but I would say something probably close to half in data centers, probably a slightly smaller percentage in fiber, maybe 35%.
I think if you look back over the, say, last 3-4 years in Europe, there's been a lot of investment in fiber. And that's been driven by, European-wide targets for fiber coverage that have been implemented on the country level. But there's also been a bit of a retrenchment as some of the fiber businesses have underperformed. We've seen a couple of insolvencies in Germany, in particular, and the UK. You see the occasional towers deal. These are nice, stabilized assets. It's sort of super core type infrastructure assets. So it's great when they come around.
Paul and Sacha, what kinds of opportunities are you seeing in the energy transition space?
In Europe and in the US, there's a lot of platform financings that we've been doing for renewables companies. So that's kept us quite busy. I think this is probably more relevant for the European market, but on the district heating and green heat side. So there's been a lot of investment, particularly in the Nordics, but also in Germany. Industrial heating, moving that away from, for example, coal and towards maybe biomass. We're looking at, the decarbonization of industry. We're looking at EV charging. We're looking at green mobility. We haven't yet been convinced that the business models are sufficiently robust, sufficiently evolved to be investing in that, say, new frontier of energy transition, but we're definitely following it very closely.
The majority of dollars and deals is in the solar space or solar and storage. And that's, across both utility scale, commercial and industrial, and even residential solar. We're seeing a lot of DevCo loans or development company loans, developers looking for capital to secure sites, get interconnection studies done, secure equipment, and, negotiate and market PPAs. Those can be tougher for funds just because of the revolving nature of that kind of capital, the velocity of that capital. The challenge there also can be a lot of those developers have a develop and flip model where they're selling the assets, where I think our preference is more that IPP model where the borrower would ultimately own the operating assets, which I think works a little bit better for us. There's still the one-off deals, whether they're in hydro or biomass, things like that can still be very interesting. And then the other big segment that we see is kind of renewable fuels in all of its various forms. So RNG, renewable natural gas, that generally can come from either landfill waste, or it can come from more an anaerobic digester model, which tends to be kind of, agricultural related. And those can be very interesting transactions for us as well.
What are you seeing in the overlap between energy transition and digital infrastructure? Obviously, many of these digital infrastructure projects, data centers, want as much renewable energy as possible. So are you seeing opportunities yet around that demand for renewable energy to be supplied to data centers and the like?
It's probably not gotten to a point where it's really concentrated. We've been investing in platform financings of renewables businesses that are expanding, that are, and we're essentially financing them at a point where they're ready to construct, they're entering into PPAs. Increasingly, we see those PPAs being struck with the likes of Microsoft, AWS, the hyperscalers.
For data centers, probably the most important thing is reliability of the energy supply. And then on the renewable energy side, the biggest challenge is the fact that most renewable energy is intermittent, right? It produces when the wind blows or when the sun is shining. I think the good news is the projected demand for data center power generation is so high that every megawatt hour counts. So whatever you can put onto the grid, whether it's solar or not renewable, is going to be useful to them. However, you still need to back up that reliability. So I think, what'll be most interesting is we're starting to see some kind of microgrid. So these are basically small, self-contained, almost like utility-like businesses that are either connected to the grid or actually truly an island from the grid, where you could have renewable power. You could have a solar park during peak hours, be supplying a lot of the energy, then battery energy storage backup. But then you'd also, because of the technological limit still with battery power, you'd then still need probably a fossil fuel backup system at some point. The challenge is to marry, kind of the generation profile of renewable assets with the demand need for data centers, which is not a perfect fit. The massive scale of not just building the data centers, but the energy need behind them is, I think, something that might really shock a lot of Americans. We're talking about replacing or expanding a very large percentage of our electrical grid. If we're going to achieve the AI targets and the quantum computing potentially targets, basically right now the interconnection model where it can take 3 to 5 years just to get in the queue is not going to work in this model. We need to figure that out. And at the same time, we're still replacing coal plants. So that's kind of cannibalizing some of this load growth. And our nuclear plants, if you look at our fleet, the average age of the plants now, I think, is right about 50 years. And so their FERC licenses are running out. Most of those will be renewed, but that's thousands of megawatts of power that are really getting close to the end of their useful life, which will need to be replaced, repowered, what have you. So it's truly daunting amount of power that we're going to need if we're going to really achieve these targets.
Excellent. Paul Colatrella and Sacha Kamp from Infranity, thank you so much for sharing your expertise with us.
Thanks, dude.